Okay, so chapter 14 deals with the capital structure in a perfect market. However, we can extend the capital structure theory to different markets. And capital structure refers to debt financing. Debt financing. Basically, it refers to how you are going to finance your company or your products. So your company is financed by this capital, this collectively called capital, okay? Because you acquire assets, hire people, you need money. That money, long term, is what we call capital. And capital, so what are the sources of capital? So think about you started from a small company. You may have money from your pocket or from your checking account, savings account, contribute to the company. Okay, so that's called owner's equity. And then the company may grow bigger and bigger. And if it does grow bigger, for example, if your company is dealing with real estate, okay, so you started this real estate company, you buy apartments and rent it out. So you may you might be better off by using leverage, by borrowing some money instead of say you have a fourplex that cost $500,000, not let's say $250,000, and you could buy it using cash, using your 100% equity, or you could just put some down payment and borrow the rest. In that case, you have a mixture of equity and debt. So let's say equity and debt. So that's those are the two main categories of capital. You either own it or you borrow. Okay, and there are really no other choices. And then you could say, okay, it's a hybrid. It's a hybrid. So the debt can be converted into equity or the other new type of financing. But still, before it's converted, it's debt. After it's converted, it's equity. Okay. So capital structure refers to the percent of debt. So if you know the percent of debt, let's say it's 40%, you know the capital structure, the equity is 60% because altogether it's 100%. So there are a lot of reasons companies use debt financing. One of the main reasons is, the cost of debt may be lower. Okay, and it's heavily influenced by tax policies. For example, the corporate tax rate, if the Democratic Party gets control of the Congress, they were talking about raising the debt again, right? So what's the corporate tax rate right now? 21%, 27%, right? It was 40% 4 years earlier, right? 3 years earlier. In 2017, President Trump had this Tax Cut Act and reduced the corporate tax rate from 40% to 21%. And then the tax rate there's an implication of this tax cut. So if you are using a lot of debt, for example, suppose you are using a lot of debt. Let's just have an imaginary example, okay, hypothetical example, very simple one, okay. So you have revenue of $1 billion, okay? And suppose your expenses, let's say $500 million, okay? So your pre-tax income, oh no, let's say not pre-tax, EBIT, let's call it EBIT. Earnings before interest and tax. That is what we call operating earnings. Operating earnings solely based on operations only, before the capital structure or financial charges. Interest is a financial charge. Tax is a part of the government. So that's government related. So this is $500 million. Okay. And interest. So what's the interest? Suppose you borrowed $1 billion. So the company borrowed $1 billion long term, 1 billion. And suppose the interest rate is 4%. 4%. So what's the interest expense for the year? $40 million, right? So 40 million is 0.04. Okay, billion. And then you get to the 0.46 billion. This is what we call a pre-tax. And then you have the tax rate, 21% tax rate. Okay. And you get to the net income. Okay. So you see that interest serves as some kind of tax shield, reduce your tax bill. So when the tax rate is really high, using more debt can offset part of your cost of capital, right? Because when the interest, when the suppose the tax rate is 100%, you know, so the interest is 100% tax deductible, right? So it's 40% is 40% deductible, 20% is 20% deductible. So for a mature company, when the tax rate is lowered, at least it has a negative impact. Okay, negative impact there, based on this tax theory. Okay, so we'll look at more detailed stuff here in a little while. Okay, so the cost of debt, in a sense, is after tax cost of debt. So if the cost of debt is, this is a RD is 4%. So what we use is after tax cost of debt. So 4% after tax, if it's 40% tax rate, the cost of debt is, so let's do these two calculations. If tax rate is 40%, okay, 40%. So what is the after cost of debt? If RD is 4%, 60% of 4%, right? 2.4%. So your after cost of debt is 2.4%. When the tax rate lowered to 20%, as we have now, almost, right? So what's the after tax cost of debt? 80% of that, right? 3.2%. So when you lower the tax rate, the after-tax cost of debt is very high. So that discourages the companies from borrowing because you don't have that much of an advantage anymore. That's purely from a fiscal policy perspective. So the Trump, government, they understand the pros and cons there. So to go along with this tax cut, they also lower the interest rate. So the interest rate is also lower. So see here you have this 3.2%. This RD before the tax cut is 4%. If you lower that to RD to 2%, so what's your after cost of debt there? 2 times 8, 1.6%. Right. So combined, this tax policy combined with monetary policy together will help the company grow better. So the Trump policy was goes along with the monetary, the Federal Reserve's policy. Altogether, that help the companies with their bottom line. Okay, so we are going to see higher profits for the companies, and actually from the stock market reactions, we have seen that. And now, once the Democratic Party is in place, things will get reversed. However, it's also going to work because remember, it's a combination of the fiscal policy and the federal monetary policy. So you could also make it work. Okay. So that's another part of the debt financing. So the government influences. So we are going to have 5 topics for this chapter, and the major discussion is on the MM theory, Modigliani and Miller theory, and that's a Nobel Prize winning theory. And I would encourage you to look at the original work, and it's very elegant financial theory. Let's take a look. So the capital structure, so we have 98 slides. Be warned, of 98 slides. It may take us at least an hour and a half to go through this. Okay, an hour and a half, that means a minute each slide. So capital structure is really just the mixture of debt and equity. And how do we finance a firm? We can finance a company by 100% equity. And here, so when we finance by 100% equity, and we invest $800,000 when the economy is strong or weak, so we have this type of returns, cash flows. And the project cash flow depends on the economy and the risk. So suppose we are asking for 10% equity premium, and with interest rate of 5%, what's the NPV of this project? So what's the NPV of this project? So if this is an equal probability, you get a probability weighted cash flow. If it's equally weighted likely. If it's not equal, you just multiply by the probability. Okay. So you have a future cash flow, you have a current cash flow, you know the discount rate, then you can calculate the NPV. That's what we have. So that's a future cash flow 1150, and with that cost of capital 15%. So where is the 15% from? is a 10% premium plus the 5% risk-free rate. So NPV is 200. So it's better than 0. So the decision is move along with the project. It's good investment. So another type of question is, if the project is financed by equity only, how much are we willing to pay? How the maximum? So that's a break-even analysis. So that's basically 1,000. That's how much we are willing to pay. So here we have a term called unlevered equity. So what is unlevered equity? Unlevered means you have no debt, no debt. Lever or leverage means use of debt. Unlevered means no debt. So the company with no debt. Because there is no debt, so the cash flows goes to of the unlevered equity are equal to those of the project. So we have this kind of returns. Okay, this kind of returns. So if we have the initial equity investment of 1,000, it may go up 40% or go down 10%, because remember the weak economy is at 900. So that's a decline. And the shareholders' returns are either 40% or 10% negative. So that will be negative 10% here. The negative. So the expected return is 15%. And the shareholders should be indifferent whether investing in your product or not. So if the shareholders are indifferent, they either buy or not buying your stock, it doesn't matter to them because they don't make a profit. Then what you do is to lower the offering price to leave some money on the table for the investors, so that they are more willing to invest in your company. But how much money do you leave on the table? The maximum is in this case is 20%. So maybe somewhere in the middle. Now that's financed. The company financed by 100% equity. And next we are going to talk about financing a company with a mixture of debt and equity. Suppose you decide to borrow 500, and then you sell equity as well. Because the project cash flow can offset the debt, and you can borrow at this risk-free interest rate of 5%. So you owe the debt holders that much. So in this case, we are concerned with the return. So here we have the shareholder return 15%. And when we use debt, does that increase or decrease shareholder return? Well, the answer could be mixed. But in this case, I think it's going to increase because this product is profitable product. Otherwise, if your cash flows barely make it, and then all of the cash flows goes to the interest payment, then the shareholder has nothing left. In that case, the shareholders are going to suffer. So the leverage can help you or really hurt you. It depends. So let's look at this shareholder returns. So my bet is going to exceed 15%. But by how much? Can we go to 18%, 20%, 50%? So we need to do some calculations here. So given the company has this debt obligation, the shareholders will receive only this much if the economy is strong. If the economy is weak, the shareholder can only get this. And then it's a weighted average, right? Because equally probable of a strong economy or weak economy, just the average of these two. So that's what we get. So what's the levered equity value? And this is what we call a portfolio replication method. Portfolio replication, or law of one price. Law of one price. If you look at the law of one price, this sum should equal to 1,000. So this E should be 500. And if E is indeed 500, what's the shareholder return? Then we can do a calculation. So the E should sell for 500. And what's the best capital structure choice for the entrepreneur? See, Modigliani and Miller argue that a perfect capital structure, the total value of a company should not depend on capital structure. So in a perfect capital market, that means no frictions, no transaction costs, no tax, no interest, no nothing there. Then the firm is indifferent by using debt or not. However, we know it's the assumptions some of the assumptions do not hold. So let's look at here. So if the value of debt is 500, value of the company is 1,000. So the equity value should be 500. And in this case, you still raised 1,000 by issuing debt and equity. And because if you don't use that, you raise 1,000. You use that, you raise 1,000 as well. So you should be indifferent between these two choices, because either way it's 1,000. And then we look at the effect of the leverage. As I mentioned, what's the shareholder return in both cases? And the discount rate changes as well, because it's riskier. It's riskier once you use debt. Let's take a look. Okay, so we have this 500. These are the original cash flows. So the returns, that's what we calculated. So debt holder gets because risk-free 5%. What's the equity holder return? So this is what we call a financial engineering, right? Financial engineering. Previously, the shareholder return is 15%, and now it's 25%. You see, it's 25% now. And then a lot of companies financial companies, they are doing this financial engineering. For example, especially in the real estate market and commodities market, they use debt financing to enlarge, to amplify shareholder returns. And this is one case, right? You amplify your shareholder return from 15% to 25%. There's a cost. The cost here is the risk increases. However, if you can afford that risk, it will be much better for you to use leverage. Is that right? So because you almost double your return. Like if you are going to work for Stevens Inc. in Little Rock, we have a number of students. After they graduate, they join Stevens Inc. It's a very good company, and some of the students are working on similar financial transactions. And the effect of leverage on risk and return, the returns for equity holders increased, and the risk increased as well. So how do we see the risk increased? Because before you use debt, the returns are 40% and 10%, right? That's your risk. And now you are having a chance to lose 25%. So the risk increased, and then you get a higher return. So nothing is free. The higher return comes from the higher risk. And we can evaluate this relation by looking at the sensitivity of the return to the risk. Let's take a look. So return sensitivity is looking at the difference. Okay, looking at the difference between the two returns. So for debt, because either way you are going to get paid. So the project cash flow can cover the interest payment for sure. So the debt has no risk. That's why, when you go to the bank, you want to borrow, they want some collateral. If you get collaterals, then your rate will be much lower. If you don't have any collaterals, then they are not going to lend you money. If they do lend you money based on your credit, then you are going to get charged a higher rate. For unlevered equity, 50%. The spread. For levered, it's 100%. So it's much higher, okay, much higher risk, and double the return there. That's the excess return. The excess return, if we are subtracting the risk-free rate, it's what we call a risk premium. So that's the excess return, the return in excess of a risk-free rate. So that's another, that's the definition of risk premium. So the debt has zero risk in this case, and risk premium, and equity doubled its risk, and the risk return also doubled. So in summary, in perfect market, if the company is 100% equity financed, the equity holder gets 15% return. If you change your capital structure, you can double your return from 15% to 25%, almost double. And I would encourage you to practice by maybe, why not let's use 80% leverage, 20% equity. What's our return? And that's a secret in the real estate market. If you put as little down as possible of your own money and you borrow from the bank, if you can generate cash flows, if it's a cash flow positive real estate product, then your equity return can be 10%, 20%, 30%, or even 50%. Of course, if you cannot achieve positive cash flows, then you may have negative returns. So the leverage increases risk. So the shareholders deserve higher returns as well. And as I mentioned, I would encourage you to do this calculation by changing this to 800, 200. So 80, 20%, 80%, 20%, and redo this calculation. Okay, redo this calculation. Okay, so the theory is what we call a Modigliani and Miller theory, and it's one of the Nobel-winning finance theories. And if you look at the original paper, let's take a look. Scholar, when you look at papers, we can use Google Scholar. Modigliani. Okay. So we'll look at their original paper. That's I believe it's 1958. That's a paper. So look at this paper. It has been cited for 26,000 times. So it's a widely cited paper. It's a very good paper, very nice read. I really like this paper a lot, and I read it multiple times. And if you are, going to study finance for advanced degrees, I would encourage you to read this paper. And it's only 38 pages. 38 pages in a very good journal called AER. Okay. Based on this work, they got the Nobel Prize. Okay. So let's just look at the first page, okay? And what is the cost of capital to a firm in a world in which funds are used to acquire assets? So that's your capital, right? And then you have the assets on your balance sheet whose yields are uncertain. So that's a business. So if it's certain, it's not a business, right? So business is all about uncertainty, and in which capital can be obtained by many different media, ranging from pure debt, representing money mixed claims, to pure equity, giving holders only the right to pro rata share in the uncertain venture. This question has vexed at least three classes of economists. The corporate finance specialist, concerned with the techniques of financing firms so as to ensure their survival and growth. So if you are going to work in the company as a financial manager, you need to make sure the company has enough capital to run its operations. and you are going to be under a lot of pressure because Elon Musk just admitted, he is just 1 month from bankruptcy. Second, the managerial economist concerned with capital budgeting. Capital budgeting basically means how you allocate your resources. You want to choose those positive NPV projects. Third, the economic theorist concerned with explaining investment behavior at both the macro and macro levels. So that means they are concerned with how much data on aggregate the companies use. In much of his formal analysis, the economic theorist at least has tended to sidestep the essence of this cost of capital problem by proceeding as though physical assets could be regarded as yielding known. Given this assumption, the theorist has concluded that cost capital to the owners of a firm is simply the rate of interest on bonds and has derived, etc. So if you are interested, look at this paper, and I think if you are interviewing for big companies, especially as a financial manager, you may be asked this type of questions on capital structure. So what is a capital structure, and optimal choice of capital structure, debt financing, the consequences of debt financing, pros and cons of debt financing. That's one of the big questions. Another big question we have discussed last week was the capital asset pricing model, CAPM beta. And that's exactly what you are doing for your project. We are going to discuss more about that 2 weeks later. So where are we now? So we are 26. So now let's look at this. This MM theory is based on a law of one price. Law of one price. So that means leverage will not affect the total value of the company. And then once you have different assumptions relaxed, you have this transaction cost, tax, etc. Then you are going to have different results. And they have MM theory number 1 and number 2, and then they have different extensions. So this is what we call a perfect market. So the investors and firms can trade at the same set of securities at competitive market prices. Usually this is not true. No taxes, not true. But these are the assumptions that they can derive their theory. And then they can relax. What if there's tax? They can redo the math and find out. So this is like a benchmark, okay, benchmark. So the proposition 1 is in a perfect market, the total value of the company equal to the market value of total cash flows generated by its assets, and is not affected by choice of capital structure. And this is also called a capital structure irrelevant theory. So if there are no taxes and no other transaction cost, then the law of one price will hold. And because of that, the company can borrow. All the investors can borrow themselves. If the investors borrow, That's what we call a homemade leverage. So the argument made by MM is that if the investors don't like this debt financing, or they prefer debt financing, the investors can do this themselves. Assume you use no leverage and you have an all equity company. The investor can borrow and create a similar effect. This is what we have. So the implication of this slide is, so the company itself is not leveraged. So the company issued $1,000 equity. As the investor or shareholder, I invested this 1,000 in the equity. At the same time, I borrowed 500. So that means I borrowed 500. That's my own debt financing for the investors. So this is essentially leverage from the investor's perspective. That's what we call a homemade leverage. Okay. So what's the total equity investment? It's 500. And you achieve the same cash flows. You see exactly the same. So it doesn't matter whether the company borrow money or not. As long as we can do it ourselves, doesn't matter. We can do any kind of leverage we want to as investors. Say we can borrow 800, we can borrow 600. So we can use different kind of home leverage here. So because of the investor can do this, so the value must be 500 in this case. So that's because of the law of one price. Now assume you use debt and investors prefer to hold unlevered equity. And the investors can undo this leverage. Okay? See, here's what we have. So essentially, we can replicate unlevered equity by holding debt and equity. So we can hold 500 debt and 500 equity. And together we have 1,000. So in each case, your choice of capital structure does not affect the opportunities available to investors. So the argument is either the company can do the leverage or the investors do the leverage on themselves by themselves. So the end result should be the same. So let's take a look at one example. Suppose there are two firms, each with state 1 cash flows 1,400, 900. The firms are identical except for their capital structure. One is unlevered, and its equity has a market value of 510. Does that proposition hold? What arbitrage opportunities is available using homemade leverage? And here, if you look at here, the equity has a market value of this much, 510. And if what we calculate is higher than 510, we could arbitrage, make a profit. you see that so total market value of 990, whereas leveraged firm has a market value of this much. So the price violate the proposition, and then we can use homemade leverage to make a profit. So essentially, we borrow 500 and buy the equity for this much, and recreating the leverage by lever of the levered firm by using homemade leverage for cost of this much for 90. And we sell the equity of levered firm for this much. So the difference is what we have the profit to 20. And here is a picture of what's happening. So these are the actions. So you borrow this much and then buy and sell. And you have this profit. Your net cash flow is a profit 20. So that's arbitrage, no risk. You see, you have no balances whatsoever later on. So that's your net profit. Next, we look at the market value of balance sheet. So what is balance sheet? Balance sheet has assets. And then you have on the left-hand side, you have assets. On the right-hand side, you have liabilities and equity. And in this case, we use all market values. Then it's called a market value balance sheet. So here is some typical items on the balance sheet. We have assets, and assets could be tangible or intangible. And you have liabilities, debt, and equity. And these two, if the balance sheet should equal, these two should equal, okay. And if these two equal, okay, if these two equal, and here's your chance to value a company. And if you figure out, let's say for GE or GM or 3M or any company, okay, if you figure out the market value of their assets, suppose the market value of assets is 50 billion, okay, if the company has liabilities of 20 billion, what is the equity value? 30 billion, right? And if there are 1 billion shares outstanding, number of shares, 1 billion. So what's the share price? It's $30 per share, right? If the company is selling for $20, should you buy this company on stock? Should you invest in the company or not? So the answer is yes. And I believe Warren Buffett used this type of techniques regularly to buy undervalued assets. Undervalued. So they invest in companies at $20, and then it goes to $30. Yes.
So you said if they're equal, There's no arbitrage opportunity, correct?
Correct.
So if they have 30 billion in equity and 20 billion in debt, are you saying that if at the stock market price, if the price was at $20, you would buy it? Because technically it should be at $30.
Correct.
Oh, okay. Just clarifying.
So that's a good question. So another question is how confident are you with this $30 price target? So suppose the company GE has the intellectual property, okay? So right now their value is 5 billion. You think it's going to be should be 10 billion, okay? So you identified some source, and it really depends on how confident are you with that estimation. And if you ask 20 analysts or 20 different firms, they may have different estimate of this market value of assets. And if it's Warren Buffett, he has better use of the asset. He has connections and have better use of the asset. So the value may be enhanced so that he could increase the stock value from 20 to 30 because he can boost the market value of the asset. Okay?
Dr. Who?
Yes.
If we followed this, so if we looked at a company, it doesn't matter what company it is, and we looked on this assets versus liabilities, if they have to equal, could we just look at their past accounting statements, like the balance sheet or their income statement, to decipher what their assets are, kind of create an estimate for their assets, and then do the same thing for their liabilities? And if they don't match up, go more into, do you get what I'm saying? Like, if we can get a number to this, wouldn't it be fairly easy to invest in some way? And I say easy very loosely.
So that's a very good question. So that is the difference between accounting and finance. So look at this phone. Okay, this phone. And this phone is iPhone 8. So I paid, let's say I paid $900 because it has a big memory. So accounting on the books, this has a value $900, right? Okay, let's use a 5-year, maybe let's use a 5-year depreciation. Goes down to 0. So I've used this for 2 years. So what's the value now? You know, 900. You used, you have used 40% of that. You have 60% left, right? 60% of the 900 will be 540 on the book, right? Let's use a straight line depreciation. If I use a double decline method, maybe on the book it's 400. Then that's the book value. We are talking about now is a market value. If I put this on the market, how much do you think I can get?
Probably not what you bought it for.
I bought it for 900, right?
I'll get a little less than that.
How much are you willing to pay to buy this? I'll just sell to you. It's a deal.
How old is it?
2 years old.
iPhone 8.
2 years old.
2 years old?
It's an iPhone 8. Now it's an iPhone 12, right? The new one is iPhone 12. Only sell for $800. The newest one.
I'd probably buy it for about, I don't know, a little bit less, maybe like $350 to $400, something like that.
Wow. If you give me $350, well, I'll just give to you right away. Okay. And then you go to the tradein.com, whatever, and then you find out, okay, the price you get is 150, 100. And it also depends on the condition of the phone, right? Is the screen still okay, right? And how is the overall performance? Say this morning I went to the park. I got up around 6 something, and then I did I ran there. Okay, it was 50%. Okay, battery. And then I ran about halfway. I look at what's my battery. It says okay, it's 20%, 20% left. And then after I run another 100 meters, I check again. It's 10% left. So basically, it takes 1 minute or 2 minutes to drop from 20% to 10%. And then I run another 500 meters. It's at 1% battery. I don't know what Apple did. So after hearing this, how much are you willing to pay to buy this phone?
I probably wouldn't buy it.
Right. So the market value is very hard to get. So it depends. People are willing to pay different prices for different, for the same item. So to answer your question directly, if you really have good skills and you are sure, this market value of the company's asset should be such and such, like Warren Buffett, he has the capital necessary to make those calls. He has a better access to the valuation of those assets. Okay, and then yes, you will make a profit. So one way, Warren Buffett has a deep pocket is, the company is distressed. When the company is distressed, the company assets cannot sell at a fair market value, right? Because you are distressed, people just take advantage of you, right? If you inject capital into the firm, suddenly the market value increases, then you make a profit there. Okay. But anyway, that's a very good question. Very good question. Okay.
Dr. Hu, I also have another just question. So if this is supposed to be the basis for, if this equation is supposed to equal one another between assets and liabilities, and the stock is low, well, let's say the formula is equal. So the debt, the equity equals its assets. There still be potential for error simply because the stock price is supposed to reflect more than just the value of the company. It's also supposed to reflect conditions within the market, the management team, the board of directors, like all these variables that you can't equate with numbers. Does that make sense?
Yes, it makes sense. So then you would have a lot of factors influencing that price. So so whatever price you get, it's not going to hold forever, and you're going to have a lot of errors there. And that's why I would encourage you to look at a book called a Margin of Safety. Margin of Safety. And a portfolio manager in Little Rock told me, I'm not going to invest until I find a value I have at least 30% to go. 30% is their margin of safety. Apparently, this will make it. Okay, if the value, if the price increases to 20 and 24, you still have 6 out of this that will be 20%, right? So if this declines by 20%, okay, so there's some kind of price ranges, okay, and you mentioned managerial capabilities, right? So that's why when the company change management, usually it's a good sign. Okay, so when the management changes, then all of a sudden the value increased, right, or decreased. People like that manager a lot, that CEO, or they don't like it. Okay, and that is really hard to estimate. Do you think Tim Cook is the best manager for Apple? I don't know. What if Tim Cook just left the company? What if Bill Gates quit the company, and then Steve Ballmer, and then you have this another executive? See, the price keep increasing, right? So yeah, that's another factor, a very important factor.
Would you say that book was called Margin of Safety?
Yes. Okay. You can find a PDF version online, I believe. Okay. Otherwise, I could email you a copy or post a copy online, but you can find it online. It's a relatively old book, but a very, very good one.
Okay, I'll have to check that out.
Margin of safety. Okay. Right there. Risk-averse value investing strategies. Okay. Well, I shouldn't deter, but I have to deter a little bit to serve you better. This is the so-called value investing. Value investing. We are basing the investment on the value of the assets. This is what we call the old school. This is a traditional. This is a Warren Buffett style. And now there is a new style replacing, or at least a competing style, which is a growth-based. They say, hey, doesn't matter the value of the assets. Hey, not important. Look at the future. Look at the growth. Look at the growth of that, DocuSign, Zillow. Look at the future of that Tesla. Look at the whole huge market. That's what's going to drive the value. So instead of looking at the value, market value of those assets, you look at the potential, the growth potential. Oh, that's even harder, right? That's even harder to estimate the growth. But nowadays, there is a new stream called growth orientation. They are arguing that the growth-oriented stocks outperform the value stocks. We'll find out 20 years later. Okay, we'll find that out. Because it's just in the process. Nowadays, you see a lot of people doubt because value investing is not working very well nowadays. And if you are doing value investing, you are really doing those, you are missing out on the growth. Okay, if you are doing value investing, you are never going to invest in Tesla. You are missing a lot, right? So, or Netflix, or so it's a very good question, and I would encourage you to look at those, and we should have an investment class, but we just don't. I used to teach this global investments in my as international finance. But because we don't have an investment class, so that when you ask questions related to that, I'll try to answer a little bit in depth. Okay, that's another detour. I think we are halfway there. Yeah, I like to have questions, interactions such as this. Sometimes if there are no interactions, I just read the slides and then we'll move really fast. It's not easy to value the assets. For this small phone, it's tangible. Look at the patents. Look at the BlackBerry. They have a huge portfolio of patents. What's the value? Well, you could say that's almost zero because nobody cares, right? So it depends. And I believe some of you probably has done some yard sale. If you have done any garage sale or yard sale, the value of that item, sometimes really just randomly priced, right? So it's really hard to get a value. If you have 10 people stop by, they may give you 10 different prices. Okay, so my friend hold a yard sale 20 years ago almost. And he had this toy. It's pretty good toy. I think he can sell for $10 at least. So he just wrote a line called just pay whatever price you are willing to pay. So someone just came in, took the toy and left a quarter. Well, that's a quarter. Well, since you said, just pay whatever price, I paid more than, a penny, right? So you may have some similar stories, right? Do you have a story about the prices or yard sale or anything?
I went to an antique store one time with my girlfriend. While she was looking around, I was just perusing, and I found it was like a glass, just a glass cup that had like a Looney Tunes character painted on it. It's like a collector's type of thing. And I thought, this is kind of cool. This reminds me a little bit of my childhood. I bet if I bought this and resold it at a higher price, someone would buy the nostalgia behind it. So I think I paid $5 for the thing. And I put it on eBay, and I think I sold it for 15, and that dude paid for shipping too. So in theory, he spent $22 on this one item, and I was shocked. So
you could do that. Nowadays, it's a good time to do it because Thanksgiving, Black Friday is right around the corner, and you can buy a lot of good items, and hopefully you make a profit out of it. And do you guys have any good deals in mind? The deals out, I haven't been tracking those deals. Do you guys have any deals recommend to me? I'll be happy to buy some any bargain items. No, nothing yet.
No.
Okay. Well, if you do, just send me an email message. Hey, Dr. Cool, this is on
What about
sale.
you,
This is
Cola?
good.
Do you know any deals? Do you know any deals, Cola?
No, James. I'm just waiting if I can get any good deals on iPhone 12, but I don't see. My ex is just trading in for $250. So I'm like, okay, that's not a good deal.
I bought a pair of pants, running pants from Adidas. I think it's $15, $16, but I think you can get those, at $15 to $20. It's not a big bargain, but I need it anyway because it's turning cold. I need the long pants to run in the outside. So I also bought some shirts, and my shirts are always cheap. I just buy for usually under $20. So I'm not rich, so that not luxury style. But anyway, I think you can get some bargains. Yeah, I think I need to get another monitor for my home office. I have a monitor, but I think the colors I don't quite like. I need to get a new one. And my budget is under $100 for computer monitor. I can connect to my laptop. I think there are some Dell monitors out there, but I have to do some research. Sometimes it's really not just money; it's fun as well, right? So you enjoy. I told my wife, hey, I fixed this lawnmower, for example. I saved maybe $100 if they fix it at a dealer's place. Maybe they charge me $100. So I fixed it for maybe $13 or so. But sometimes you derive the joy, you enjoy that process, right?
There's something nice about figuring.
That's priceless, right? So, and I maybe have talked about that AC. My AC broke. I think I talked about this in the summer. It broke. Air conditioner broke, so there's no air coming out, and it's very hot. And it was on Thursday, and three different companies came in and looked at it. One said, okay, replace the whole thing for you, $20,000. And another came in, okay, hey, this thing, big thing, it's broke. I'll give you a price next Monday. And another person came in and say, okay, maybe your blower, whatever, that thing is broke and is broken. Maybe, you need to replace that new for at least just $3,000, $4,000, $3,000. Because then the next day is Friday, so Friday, okay, I thought, okay, what should I do? Wait till next week and find out or what? And I asked one of the guys, it doesn't make sense to replace the whole thing, right? So can I just take apart the thing? He said, no, you can't. But sure you do, you can. And Saturday morning I went upstairs and I just look at the item. Hey, just take it apart. It's quite easy to take it apart actually. I took it apart and then I took out that electric board. There's a circuit board, and I found one of the things, capacitor. On top it's black stuff. That was burnt. And that must be the issue. So I bought one for maybe $3, two actually, for $3 on eBay, and came in Wednesday, I think. And then I put one in. I have to solder it in, and it worked for $3 or $1.50, whatever you said about it. You say about it, but this is all about is if you derive some, you have derived benefits. You have derived benefits. Then that is something different. Okay. So since this is corporate finance class, that example is not directly related, but I do have another. One of my research papers, we studied a block of shares. block of shares. Basically, say you buy a block of a stock like 1,000,000 shares of GM. For this block of shares, you usually do not buy from the market. Okay. GM probably 1,000,000 you can buy it easily, but for smaller companies, that 1,000,000 shares represent maybe 30% of the company. You really cannot buy it on the market, right? So suppose the market price is $20 a share. We studied how much are people willing to pay for that $20 per share for 1,000,000 shares or for 20% of the stock or whatever, 20% of the company. Do you think people are willing to pay more or less relative to the $20 per share market value? And what we find is that people are willing to pay more than $20 per share. Sometimes $25, sometimes $30. Okay, that's what we call a block premium. So you would think you buy bulk, wholesale, you will get a discount. No, you need to pay a premium. That's the stock market.
Doctor, I may have missed this, but where would you go and buy 1,000,000 shares at? You said you don't buy that just in the market.
For GM, we probably can, but for others, it's multiple ways. One way is called negotiated. Say I have $1,000,000 shares, and you want to buy 1,000,000 shares. You just call me, right? And you know who is holding the company stocks. Okay. They need to disclose. If they are holding 5% or more, they need to disclose. Okay. They are considered insiders. Okay. So it's called a brokered, or you can call, say, Goldman Sachs. Say you want to buy 1,000,000 shares of Tesla, they'll help you. Okay, they'll help you out. Okay, and they'll ask you how much are you willing to pay. Right now it's $20. How much are you willing to pay? You say 30, or they'll buy it for you, right? They'll make a commission out of it too. And then you tell Goldman Sachs, hey, I want to buy the entire company. You say, okay, sure deal. $20 right now, how much are you willing to pay? 40? And then the Goldman Sachs will talk to the management, to the company board. They say, oh, double our return, good. We'll sell it. That's what we call merger acquisitions. You are acquiring the other company. Usually, when you are acquiring another company, you pay a significant premium, right? 20%, 30%, or even double. That's quite possible. But those are negotiated. Okay. That's a very, very good area, merger acquisitions. And if you know some company is going to be acquired, if you know beforehand, you'll make a fortune on it. I'm waiting for BlackBerry to get acquired by other companies. I've been waiting for 5 years. It's still not happening. So okay, market value or balance sheet. So by using that valuation approach, we can really find out the market value of equity, find out the stock price. Okay. So there are some examples, and I'll post the slide. You can find out the solutions. So in this case, you have debt, you have this warrant, The warrant is something you can convert into equity. And suppose the third security is fairly priced at 60. What's the value of equity? So if the warrant is 60 and 200, right? 210 versus 0, then you can, based on these probabilities, then you can value the equity. So if the value is 1,000 total, the debt is 500, that warrant is 60, and it is subtracted, 560 from 1,000, you get 440. So law of one price. And the next 7 slides talk about a leveraged recapitalization. What is recapitalization? Recapitalization basically is, say you have right now you have let's say 100% equity. You just change it to 50%, 50. That's called a recapitalize the company. The capital structure changed. Or it could go the other way around, or it could go other different percentages. So when the capital structure changes, that's what we call a recapitalization. And there are ways you do this. For example, you can issue debt to buy back shares. And you can issue shares to pay debt. So that's all financial engineering in my understanding. So this company is all equity, and they can borrow to buy back stocks. Okay. So increase leverage, borrowing 80 million, and use that to buy back 20 million shares. So when they do this, usually the company's stock price will increase. Okay. That's why for share buybacks, that drive up the stock price. In the last few years, that has been the driver for the market. So issue debt and buy back shares. And that's after borrowing. That's before you have 200 equity. And afterwards, in the middle, you have 80 debt, 80 cash, that offset. And this is offset, right? And afterwards, the cash is used to buy back shares. So this is a complete. And now you see 100% equity transformed to a mixture. It's recapitalized. And the share price stays the same, theoretically. But in reality, usually you see an increase. So this is a law of one price. Okay. And after borrowing, the asset equity. So this is the intermediate step, and then the share repurchase. And this makes a good financial modeling exercise if you do financial modeling. So these are three steps. To do the share buyback, so the company borrow money, convert into cash, and you use cash to buy stocks, and then you can recalculate the stock price. It's still $4 per share. And of course, we can have discussions on this a lot. So say this is the capital structure. Once we borrowed, does it change this part? It does not change these assets, right? The assets will not change because you borrow or not, right? Supposedly. Unless the assets are sensitive to your capital sufficiency or whatever. And then you do this and do this, buy back stocks. But when you buy back stocks, I do see something like a supply and demand. You are decreasing the supply and creating some demand for the share. When the demand for share increases, the share price usually, from a supply-demand perspective, the share price should increase. Okay, so previously, that's called no tax perfect market. And then the MM2 deals with what if there are, some of the assumptions do not hold. And here the proposition 2 look at the leverage and cost of capital. And we can derive the cost of equity here. We can basically calculate this. And we have these terms. Equity, debt, unlevered market value. A is the market value of assets. So EDUA. These are just abbreviations. And the proposition says the firm's assets should be claimed by equity and debt. And the cash flows will flow to part to the debt, part to the equity. So basically, either you do it by the company or the investors can do it. So the cost here is what we call the weighted average. Okay. So these are the weights, the percent of equity, percent of debt, right? So you call it a WERE plus WDRD, right? So essentially, this is a weighted average. And then from this equation, we can solve the cost of equity for the levered company. This is a risk without leverage, and this is an additional risk. So you see, when you use leverage, the risk increased for equity holders. That's how much it increased. So I should make a final exam question based on this, right? And I think this is interesting. You can derive this. I could easily ask, if you have this type of companies, one unleveraged, one leveraged, what's the additional risk due to leverage? Simple, right? Just from this equation, get to here. And this is the additional risk due to leverage. Okay. But in a final exam setting, you may panic and you may say, hey, how do I do this? And this is the same equation. They just change the capital R to small r. So if the firm's all equity financed, it's a 15%. So what's the RE for leveraged? So 15% must be higher than 15%, right? How much higher? You can put this in and do the calculation here, 25%. So I could either ask you abstract, just based on symbols, or give you some numbers, you get a number. Usually students like numbers better than the symbols. But professors usually prefer symbols instead of, because symbols, you could solve a lot of problems. You can plug in different numbers, right? That's more theory, right? And numbers are more empirical. And then you could do this kind of calculations. You borrow only 200 to finance the project. What's the equity cost of capital? You borrow 200, 800 is, so you decrease your leverage, then the return will be decreased from 25% to 17.5%. And here it says the cost of capital of assets should be equal to the cost of equity for unleveraged firm. And that's our weighted average cost of capital. You see that, right? Weighted average cost of capital. We have covered this already. And WACC is independent of capital structure. That is in a perfect market. When there's a tax, when there are other implications, then WACC is capital structure dependent. So WACC and the leverage, you see, WACC, it stays the same, it's a yellow line. And equity increases with equity return. Cost of equity increases with leverage. Cost of debt also increases. So with no debt, this is equal to a cost of equity because no debt. With debt, it's a mixture. It's a weighted average. And then we have some examples. I'm going to skip this example. It's just plug into this equation and do these calculations. Basically, from 8% increase to 10.5% due to this leverage. It's a 50% leverage, right? 1-to-1 ratio. And we can compute the WACC for with multiple securities. So if you have different securities. And here we have equity, E, debt, and W is warrant. And you could have a preferred stock. And those are just hybrid type of securities.
What is warrant?
What is the warrant? Warrant is a right. So basically, if there is a threshold, then if reaches certain threshold, you get the whole thing. You get whatever payout. Otherwise, you get a different payout, a 0, for example. Okay. So that's similar, or it's similar to options. Okay.
Okay.
And there's a definition for warrant in the previous slides, and of course you can also Google it. And a warrant would be good for incentive purposes. For example, if you are the CEO, I'll give you some warrants, okay, as a board. If you hit this performance, and let's say you increase the revenue by a certain percentage or whatever, the share price goes to $20, then your warrant will become valuable. Otherwise, it's meaningless. Okay. So warrant could be converted into shares, for example, to convertible. And I believe there's a definition earlier, but you apparently can search online for warrant. Okay. You have to search for stock warrant. Okay. Okay. So from this description, you see that if you are the CEO, the executive, whatever, you can get this kind of warrants. But the general shareholders usually do not get the warrant. Occasionally, when the company is expanding, the existing shareholders may be issued some warrants when the company keep expanding and raise more and more capital. And then in that case, you could have a warrant. But in general, it's used for the as incentives. But options can be used, and you can buy and sell easily. Warrants probably not. And you could have like a debt holders, the banks lend you money, asking for some warrants too. So that could be financial engineered. Okay, we are almost there. We have 20 slides to go, but I think I'm going to skip some, but almost there. The effective leverage on risk. So here you see it's a weighted average of beta, the equity beta and debt betas. So we can calculate a levered beta from this equation. Okay, just solve for this, right? You see. So instead of cost of equity, I can ask you for beta. And this is an example of plugging in the numbers to calculate a levered beta versus unlevered beta. We see that levered beta, because the risk increased and you see the number increased. Cash and cost of capital. Cash can be negative debt, can be considered negative debt. Okay. And when we plug in, we see that the beta, there are changes in the beta. So for levered beta, that's 1.09, and now you have 1.45. We see that because the cash holdings, that equity is less risky than its underlying business. You see, because of the cash holdings, this beta is lower relative to this. And there are 5 fallacies: leverage and earnings per share. I'm going to skip these 5. And this is a visualization of the previous example. And this is another example. And when you issue equity, that's what we call a dilution. A dilution usually is not good for the company. I'm going to skip this 6. And beyond the propositions, of course, we have a lot of things to cover. And I believe there's another chapter in the book talk about taxes and different factors. And that's really, related to the reality, more correlate to the reality. If we have time, we should cover that part as well. And usually corporate finance in a lot of universities is split into corporate finance 1 and 2 semester class. And in the 2 semester class, the second semester usually deal with advanced capital structure theory and merger acquisitions like we discussed, we touched upon very briefly. That's it. So, well, it's a long class today, and I'm going to let you go. And if you do have any questions, please just let me know, and we'll talk more about the project, individual project data case, and also assign a group project next week. So if you have ideas, let me know. And thank you so much for sticking around for such a long time, and thanks so much for the questions. So any more questions? No? Okay, so yes.
Dr. Ho, this is not related to the class. So I think a couple of weeks ago, I was just trying to do a project that Dr. Hill wanted me to do. It was on the Excel sheet, and I had a question. I tried looking at one of your videos. Would you mind me asking, Dr. Ho, how did you get the complete picture in the Excel into the Word document?
Complete what?
Complete picture. Like, do you remember when you gave us the midterm review, you copy pasted everything as it is, the Excel along with the rows and columns into the Word document?
Yes.
How did you do that, Dr. Hu, if you don't mind me asking?
$5. How much are you willing to pay?
It's just a part of my class, Dr. Hu. I'm already paying so much tuition.
Yeah, ask Dr. Hill how much they are willing to pay. They are rich.
He told me Dr. Hu is a smart man. I think you should go ask him.
Well, I'll give you for free, but if you do talk to them, charge them some, at least a cup of coffee. Say, Dr. Hu ask for a cup of coffee if you want to know it.
I'll do that.
You can get it for free, but if they want to get it, they need to pay. Okay, it's a deal.
I'll do that. Yeah.
Okay. So if they somehow get to know from you, you owe me a cup of coffee, and they owe you. You can ask them for 2, then you can keep one. Okay. Okay, here you go. So the question is, how do you copy and paste
and get
and
the rows
show the column headings and row headings?
Right.
It's not easy. So there are 2 ways you can do it. One way is you can just simply create your column headings A, B, C, D, and row headings there. That's one way. You know how to do that, right?
Yes.
Yeah. So it's easy. You type in A, B, C, and 1, 2, 3, whatever, 16, 17, 18. That's one way you do it. But that would be the boring way, right? I know that's what you are. That's not what you ask. You wouldn't say, okay, if I copy this, I want to show B, C, D on the top and 12, 13, 14, 15 on the left. Okay.
Right.
So if we just copy and paste, you see it's still crashing there. I don't know. Let's see. It crashed my whole world. I'm lucky I didn't wait for it. But anyway, you could paste on PowerPoint, right? So hopefully this is not crashed. Right click. I crashed this too. Okay. Control insert new slide. Okay, you just paste as a picture, right? So this is not what you want. You want the column heading and row headings. So we go back.
Yes.
We go back. We go to somewhere here. Here. And here we say print. Okay. And now we go to home. We copy the picture.
Mm-hmm.
So now if we just select this, okay, copy, and paste right here. Magic. Okay, now it's magic. And paste right here. So this is still not what we want.
Mm-hmm.
Copy. Let's see. It should work. Copy as picture. And right there, yeah, right there. Control C, Control V. I should have just used Control V.
Thank you so much, Dr. Who. I couldn't figure this out, so I just did the snip and sketch. I just, had to like take a picture of it and then insert into the Word document. Now I know how to do this. Thank you so much. I tried referring back to your video, but again, it showed the same error when it showed the first time, saying we cannot access it. So I'm like, okay, might as well just ask you.
Okay, hopefully you can get a cup of coffee for me, okay?
I hope so too. Thank you so much.
Well, you're welcome. Okay. I'll see you guys next week. Any other questions, James?
I'm good. I think I'm good for today, Dr. Who.
Okay, well, hopefully you'll find some undervalued stocks for me. Let me know, okay?
All right.
How about Lance? Are you still here, Lance? No? Okay. Well, I'll end the class and see you next week.
Thank you so much.
Sure. Bye-bye.